solution walkthrough. This is for Kiso, Weinget, and Warfield. This is for exercise 1912. The authors of the textbook are Don Kiso, Jerry Weinget, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. All right. So let's go ahead and get right to it. So deferred tax asset with and without valuation account. Jennifer Capriati Corporation has deferred tax asset account with a balance of $75,000 at the end of 2019 due to a single cumulative temporary difference of $375,000. At the end of 2020, the same difference has increased to a cumulative amount of $450,000. Taxable income is $820,000. Tax rate is 20% for all years. No valuation account is in existence at the end of 2019. So record income tax expense, deferred income taxes, and payable, assuming that the deferred tax asset will be realized. All right. So the first thing we're going to do is we're going to record income tax expense current, and then we're going to have income taxes payable. So this over here is going to be $820,000, which is the taxable income for 2020. We don't have to figure it out. It's giving it to us. This is going to be $164,000. Our income taxes payable is also going to be $164,000. Now, when it comes to over here, when we're looking at our deferred tax asset, so our deferred tax asset started out at $75,000 at the end of 2019. End of 2019 becomes 1/1/20. So right over here, what we need to figure out is what is our deferred tax asset as of 12/31/20. So what it says over here is that the same difference has increased to a cumulative of $450,000. So it went from $375,000 to $450,000. So what I'm going to do over here is that I'm going to look at the relationship, right? They're in a very serious relationship, but in here for accounting, this relationship is called 20%. So if the amount of the deferred tax, the temporary difference was $375,000, 20% of $375,000 is $75,000. So if this deferred tax asset has grown to $450,000, the amount that should be here as the deferred tax asset is going to be $90,000. So over here, the difference between these two to get from 75 to 90 is going to be $15,000. So what I'm going to do over here is I'm going to have a debit to deferred tax asset, basically over here for $15,000. And then what I'm going to do to basically to balance this is I'm going to have income tax expense deferred. And this over here is going to be for $15,000. Okay, so let's go ahead and do this. So when you go and look at the textbook, they're going to show income tax expense as being $149,000. Again, I do this for a very particular reason. It's because if we have to go through and disclose it. Now, I can go ahead and record it because as of right now, I'm assuming that that tax benefit is going to be realized. So this is going to be for part A, and this is going to be 12/31/20. So this is how I'm going through and handling part A. So I'm going to be able to get it. So this is what I'm going through and doing. Now, just let me pause real quick. Okay, so let's take a look at part B. Now, to make this a little bit easier on ourselves, like I'm saying, it's assuming it's more than likely that the $15,000 of the deferred tax asset will not be realized. Prepare the journal entry to record the valuation account. So what I would do over here is I would have deferred tax asset of $15,000. And then over here, I would have an allowance to reduce deferred tax asset to to realizable value of over here of 15,000. Okay, now my income tax expense current is still going to be at 164,000. And then my income taxes payable is going to be at 164,000. So if I am in a situation where that deferred tax asset is not going to be realized, instead of actually reducing my income tax expense, I'm just going to go ahead over here and record the allowance. What you'll notice is in the textbook solution, they're debiting income tax expense and then they're crediting the allowance. This is in effect accomplishing the same thing. My income tax expense is now at 164 instead of a combined 149. I'm just doing this because I think it makes more sense to me. And I guess that's what's important at any event, not to be so self-centered. I want to thank Wiley for allowing me to use their textbook, their questions. If you'd like to see other solutions, please feel free to ask for them in the comments. Thank you so much for joining me here today, and I look forward to seeing you on the next video. Have a great day.